European shares continue to recover after last week's rout. Welcome to Market Insight, I'm Ramzan Karamali. Well, big banking stocks led the way today, with the focus now turning to more data and commentary from central bank officials. But is the worst over for European markets? Or are investors bracing themselves for more turmoil once French elections have actually taken place? Well, to help answer that and much more, I'm joined by Mark Niznik, lead manager of the Artemis UK Small Companies Fund. Mark, thanks so much for joining us. So, are investors still nervous about the political situation in France? Do you think the steadying we've seen over the last few days is just the calm before the storm?
I think certainly what's happened in France since the snap election was announced is that the market has been quite weak. I'd defer to my European colleagues for the detail on that, but I would make a couple of points. I think that the first is that generally elections don't really make a great deal of difference if you're a long-term investor. And secondly, if you kind of compare Europe with the UK, which is my area of specialty, we've got a UK election where I don't think it makes a lot of difference for investors whether whichever party wins, that the manifestos are relatively similar. So I think although there might be noise short term, I don't think that makes difference for long-term investors.
Now, earlier today we heard from Whitbread, the owners of Premier Inn, and their room revenues fell, but the company still kept to its annual forecast. Is the recovery in hospitality sector happening quickly enough, though, to encourage more investment?
I think Whitbread said that trading had strengthened over the quarter to the end of May. They also said that their share buyback was on track. I think it's interesting, if you look at the other leisure companies that we own, it's been a similar story. So Fuller's, Hollywood Bowl, Jet2 on the beach, all had strong trading in recent months. I think the interesting thing from my point of view as a smaller company investor is this point about share buybacks. It's very rare for smaller companies to do share buybacks, and we've seen over a dozen of them in the portfolio that we have at the moment. And we were speaking to Simon Emeny, the boss of Fuller's recently, who summed it up quite well in that he could buy his shares back at half the price that he could actually go and buy a new pub at. So it made perfect sense for them to do that. And those companies that are buying back shares it's a show of confidence in not only the company, the directors of those companies are confident of the future, they have spare capital, surplus capital, and they think their shares are good value. So I would say that it's a good outlook for the leisure industry and the consumer more widely in the UK at the moment.
Now, we also seem to be getting a bit more consolidation in the oil and gas sectors. In your opinion, what's driving all this?
There's been a lot of investor scepticism about and worry over the transition from a fossil-based economy to a low-carbon economy, and that's meant that many of these share prices have been depressed. So the valuation of the cash flows that those companies are generating relative to the stock market valuation is pretty high. So that if you're a bidder, a potential bidder for those companies, the cash payback on you is relatively short, and that may be leading to some consolidation in the sector.
Now, on the economic front, we have inflation data out in the UK tomorrow. What are you expecting to see there? And is there any chance the Bank of England might do something on Thursday?
It looks likely that the inflation figures tomorrow will show inflation at near the kind of 2% target that the bank has set. So we've got an interesting situation where investor perception towards the UK has been somewhat negative over recent years. But if you look at the data, we've seen inflation coming down as that energy spike washes through the annualized figures. We've seen real wages rising in recent months. We've seen the GDP kind of flatlining and now picking up. So we think that the UK is no longer the kind of economic outlier that it is perceived to be, and that we think leads to opportunities in the market.
Tomorrow we also get results from Berkeley Homes. The builders are unlikely to get a rate cut this week, but there are reasons for builders to feel a little bit more optimistic about the future. Isn't that correct?
I think it's an interesting sector. There's a lot going on here. So we've got, as you say, Barclays coming up soon. We had Chris Nicholson announce results last week. They actually said that there's been a slight weakening in the market since Easter that they saw. interestingly, the week before we had Bellway, another house builder, say that they've seen a strong spring sales pick up. And actually, Bellway has bid for Crest Nicholson last week, which is interesting because we also had Barratt taking over Redrow a few months ago. So we've got the kind of consolidation in the house building sector as well. And if I kind of widen that out, certainly in the portfolio that Will, my colleague, and I run in small caps, we've had over 29 takeovers in the fund in the last 5 years at a 50% premium to the prevailing share price before the bid. So we think that shows very good value, not only that sector, but the wider UK market as a whole, and smaller companies within that especially.
Mark Niznik from Artemis. Interesting stuff. Many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.